Hey, everybody, how's it going? This is Seth and Jaron, and you're listening to the REtipster podcast. So today we're talking with Reid Kurtenbach. So why are we talking with Reid Kurtenbach? Because Reid has been a member of the REtipster community for some time now, and he's been funding land deals across the U.S. for land investors since 2019 using both his self-directed Roth IRA and his own personal capital. And we thought it'd be interesting to bring Reid on the show because this idea of funding land deals has gotten to be pretty popular in recent years, and for pretty good reason. There's some land investors who get into this business and they see the opportunity, they work some deals themselves, but they realize eventually that they don't have the time or the desire to do all the hands-on work themselves. However, they do still believe in the business model, and they do have the money. And likewise, there's some land investors who do have the time and desire to find and work the deals, but they're short on capital, and they need somebody who understands the land business because most conventional lenders don't, and somebody who's willing to provide the funds they need to buy the properties because they don't have enough cash to do it on their own, or maybe they start with enough cash, but they eventually run out, and they're kind of just at a standstill. And chances are most land investors out there fall into one of these two camps. And regardless of which camp you fall into, it's important to understand the perspective of a money partner like Reid, who is willing to contribute the money and let the active investor take the lead while expecting a certain return after the deal is done. So what's it like to work with somebody like this, and what are the challenges in this kind of relationship, and why should or shouldn't someone partner with a private money lender like this? There's a lot of things to unpack in this kind of relationship, and Reid is going to give us his perspective on this. This is also an interesting issue for us to explore because Jaron is actually coming from the other side as an active investor who is using other people's money to fund deals. So there's probably going to be some differing opinions and perspectives as we talk about how things should work from both ends. So,
in other words, by the end of this conversation, both me and Reid are going to be all red in the face and screaming at each other, and it's going to be fantastic. So buckle up, guys.
Yeah, we're going to walk away new enemies at the end of this.
Yeah, thanks so much for having me. I really appreciate it.
So maybe you can tell us your 60-second story. How did you first get into the land business? How long did you work on these deals on your own before you decided to start exploring the opportunity to partner with other investors?
Yeah, so I guess what I would say is that I have a varied background. I started investing in manufactured homes with and without land. And I came across a manufactured home that had burned up and the land was still valuable. So I bought the home with the land, scraped off the home, and then I was able to sell it for a pretty good chunk of change. And this was back in like 2013. And I didn't really think too much of it, but as I was investing in other properties and prices were going up in the marketplace, I kept looking around and I thought, well, there's got to be a way that I can earn the similar type of returns that I was earning back in 2012, 2011. And so actually I came across your website and a couple other websites, but I was really gravitating towards your website because I just saw so many helpful articles and so forth. And so I just dug into it that way. I shortly thereafter signed up with REtipster's masterclass, I believe, and then started exploring some deals and had done a few land deals with manufactured homes, more of those, but I started doing a little bit more research, took a couple other courses as well, and having a full-time job and my primary focus is self-storage. I was like, how do I put my money at work, but also, use what I've learned from your courses and others? And so that's where I kind of got my start.
What were some of the early challenges that you encountered when you started trying to do this? Like jumping into a deal where you've got the money and somebody else is going to do the work.
Yeah. So some of the challenges that I faced were, am I using the right contracts? Are they all legal in each one of the states? And how do I vet a land investor? I had worked with another investor in another area of real estate in the past. And if you look on Bigger Pockets, there's a lot of unsavoring posts about this individual. And I thought, how do I avoid something like that happened to me, because I don't want to deal with embezzlement or fraud or something like that. So those were some of the things that I kind of ran into, where how do I know if I can trust this other investor? Should the property be in my name, or should it also be in maybe the investor's name? So a land investor, because I call myself a land funder. And then also, what's, their requirements? How are they doing their due diligence? How does that compare with how I do my due diligence? So hopefully that kind of gives you a little bit of background of some of the things that I kind of ran into. And then other challenges were, okay, what happens if they are both on the title? So if I'm on the title, and then let's say Jaron's on the title, if I was doing a deal with him, what happens if he goes dark? He just disappears. How do I get rid of that property? And does my contract allow for that? So I guess I kind of look at things more from a stance of, is there risk how can I take calculated risk and be protected?
So one of the first questions that comes to mind for me, because I see this happen a lot, is when people will jump into our forum or Facebook group and just like make this blanket post for everybody saying, hey, like I got money, I'm looking for somebody who wants to borrow my money. How did you find people, and not just anybody who wanted money, but like good, reputable, relatively experienced land investors that you could trust? Did you like just keep an eye on conversations and like send direct messages to them? Or I don't know, like what was your process for finding the right people to work with?
First, I looked at the different land. So I'm a part of a couple different land investment groups. And so I've posted in those groups but I've mainly reached out individually to individuals like you mentioned. So direct messages. So there's like a group group of land investors that are very experienced. And some of them are actually even in your course or have taken it. And so I've reached out to those individuals. I watch some of the forums, as you mentioned. And then generally it's word of mouth. Some other people that I've funded for land deals, they'll refer me to other people. Like just last night, someone said, I don't have any deals right now, but a buddy of mine has done 6 deals. He's getting coached by me. He's looking for some money. What are your thoughts? And so he just referred me. It was like a warm introduction email last night. So as I kind of get to know people, I network with a lot of these other land funders, because they'll tell me some individuals that weren't really working out for them. And we kind of keep each other, I guess we kind of scratch each other's back in that way, when we just make sure that, none of us are funding people that maybe we shouldn't be funding.
Man, there's a lot to unpack there, because I want to know, I had like a whole bunch of stuff to comment on what you just shared, but I have to ask the question, what do you look for then in terms of like, how do you define competency, or what's the due diligence that, like, what are the boxes that you need to check in order to happily fund somebody who's the land investor, the person actively doing the business?
Have they done at least 5 deals? That's one thing. What were those deals like? And then I kind of research. I do my own kind of due diligence on the back end to see, how, did they really purchase those? They'll give me the APNs, and then I can kind of look it up and see what they paid for it, and then what they sold it for, what that time period was. And then I also do a background check on them. That's free to them, but it checks if they have a criminal background or not. And I don't care about DUIs and stuff like that. It's more like white collar crimes like fraud and embezzlement. I also check for references. I look at some of their posts online. I look at their website, see how they're listing properties. Is it blurry pictures, or are they serious about it? Are they using drone footage, not drone footage? How do they market? Do they market through a broker? Do they not market through a broker? What's their process like? And then I also look at their due diligence spreadsheet. So they'll usually send me a due diligence spreadsheet, either through like Airtable, Google Sheets, or something like that. And I'll be able to say, if I can ask them, if I don't see like floodplain as a field or legal access, then I know that I'm dealing with someone very green. Or if they tell me, like, I have a person that approached me that said, I believe I can get pretty much everything I need off of YouTube. I don't need to take a course. And there were certain things that I came across where, yes, you can get a lot of information, but they didn't realize that it was in a floodplain. They didn't realize that it didn't have any legal access. And I thought, those are really basic things. So I said, I would strongly recommend you take a course like REtipster or something like that, because these are fundamental things. And that's like one of the main things I always ask is, how did you get your education? And how are you keeping up with the industry as well?
Something that's interesting though, one of my previous land investor or financial partners, one of the things that they asked me that I thought was interesting is if I've ever lost money on a deal or if I've ever failed, and they wanted to see that failure before investing with me. So if I had been so green that I hadn't lost money yet or made mistakes yet, they didn't want to be the person to fund my mistakes. So they wanted to make sure, like, hey, have you actually lost money on a deal yet? And if the answer was no, they were going to hold off on lending. So I guess fortunately I did lose money on a deal in the past, and we ended up working together. But I thought that was an interesting question.
So you said that they wouldn't fund you if you did lose money on a deal?
So no, they wouldn't fund me if I didn't, if I had not had a failure yet.
Okay.
So they were looking for me to have mistakes in my past, so that because they, in their mind, they're like, okay, mistakes are inevitable. And land is a bit of a unique animal, but when we talk about wholesaling houses or flipping houses, it's not a matter of if, it's a matter of when you're going to lose money on one deal here or there. I mean, collectively, you're going to make money. But I know that there are guys in the land space that have never lost money on a deal. And I think that that's very possible if if you do your due diligence properly and all of that. But this guy was coming from more of a conventional like house flipping situation. And he reached out to me and wanted to know, hey, have you made mistakes yet? Because if you haven't made mistakes, I don't want to be the guy to fund your mistakes. So I thought that's an interesting, it's at least something to think through. It's interesting.
No, I'll definitely add that to the list of questions, because one of the things that I always ask is, what's your why? Like, why are you doing this? Because I don't, all the people that we fund, we're friends with. And, whether or not we've met them in person or not, we haven't met any of them in person actually, but I want to be able to give them a call and just talk about random things, and I want them to be like a buddy, as cheesy as that sounds, because life is too short. And so if I know their why, I can make sure that we're aligned, and that if I'm doing something on the self-storage side and that's something that they want to do in the future, I can help out with that and share my knowledge with them, and vice versa. I just feel like it can't be a transactional relationship.
Yeah, I like that.
That issue about, asking if you failed or lost money on a deal, that almost seems a little too black and white to me. Almost like looking at a credit report and just seeing the number, whether it's 600 or 800 or whatever, and saying, that's all I need to know. It's like there's actually a lot of information buried inside that.
I think it's a bit extreme as like a standard of like, I will or I will not fund you based on if you've lost money before, and wanting you to have lost money on a past deal. But I still think it's an interesting concept to walk through while you're vetting an investor, because you want to make sure that they've gone through the bumps and bruises and you're dealing with somebody who's competent. Like, to be honest, if Reid were to approach me after doing 5 deals, there was so much I did not know. Still, like, after I've accomplished 5 deals, it was probably closer, I would say, to like 15 or 20 deals before I really started getting the hang of what I was doing in terms of due diligence and all of that. So you have to weigh the opportunity cost there, right? Not everybody, and it depends on the deals too. Like if you're doing bigger deals, that requires more due diligence. But before we move on, I did wanted to mention, I don't know the legalities of if somebody has money and they're looking for investors to partner with, but I know that the reverse, at least from the syndication world, obviously I'm not an attorney, so this is not legal advice, but I have heard that you can get into trouble if you go soliciting money in kind of a public forum. So if you're on the reverse side, you're the active investor, and you're going to random Facebook groups to be like, hey, I want money, give me money so I can do deals, you could actually be liable of breaking the law potentially. Again, not an attorney, so seek legal advice on that. But I was actually talking to another lender friend of mine, and he actually asked me that question, like, hey, how would you go about attracting other land investors and stuff like that? And and he mentioned that he had been doing forums and all of that. And I told him, I was like, hey, I don't know if that's legal, but he said, no, it's on the other side. If you have money and you're soliciting investors, you're totally fine. So I don't know what the legalities there are, but if you're on my side of the equation, be careful there. And one final thought I wanted to share with the audience: if you really wanted to, because we all know direct mail, you could actually look up cash transactions over the last 6 months in a market that you want to do business in, find a list of land investors, and then just mail them, say, hey, I've seen that in the last however many, however so long you've done X amount of deals, and I fund land deals. So let's talk. And you could do a direct mail campaign and get lenders get active investors that way.
And I think it also depends on if you want your investor to be sophisticated or not sophisticated with land, and how much you're willing to hold their hand. Some people that can get money from their friends or relatives or whomever, that's cheaper money. They choose not to because they just want to have a sounding board, because they know that I'm looking at several different deals across the country, and maybe I'm asking questions that maybe a normal investor wouldn't ask. So sometimes that's a reason for them to use us versus just go to friends or family. But I do like that idea, because I know that that's one way that I targeted other things in other real estate niches too as well. So it's a great way to find private money.
Okay, so when it comes to the profit split between the private money funder versus the active investor who's doing all the hands-on work, how do you decide on that? Or what is your standard profit split? And if that ever fluctuates one way or another, like what would make that change?
So it's generally 55% to the land investor and 45% to the land funder. So that's for a new relationship. We cover all acquisition costs, taxes, anything that's owed to buy that property. We cover that. If we're doing several deals a month, and depending on the track record, we'll go as low as a 25% cut to us as the land funder, and then 75% to the land investor. We haven't got to that point yet because we haven't seen that much volume, but it's all about the velocity of our money. So can we move these deals very quickly? Like, we've got some land investors that buy properties for $1 or $2K and sell them for $6K within a week or so. If we could ramp that up to 10 to 15 a month, then I think we would be way more negotiable on what that split is. We don't really have there's a lot of land funders out there that say, I need to make 2x my capital, or I need to make 100% return within a certain period of time. We don't really operate like that. For better or worse, we just look at every single deal on its own and the relationship that we have with that land investor.
Is this assuming that, is that land investor paying their own cost of direct mail and holding costs in terms of property tax bills or whatever else that comes up? Are you paying for that, or are they paying for that? How does that work out?
If we have a track record with that land investor, we will actually fund their mailers. We've started doing that recently. The split changes. Obviously, it's a little bit more because we take a little bit more of a risk if there's no deals. And then when it comes to the split, it just fluctuates according to that percentage. Does that answer your question?
Yeah, I have a follow-up to that though. So are you getting reimbursed out of closing before you do the profit split? Because if I'm using the private money lender to pay for direct mail, then it's a line item that gets reimbursed before we actually do the split. So do you just kind of eat it? Because if you do, that's a great value you're providing.
It depends on the situation. It depends on that. But majority of the time, what we've been doing is that the amount comes. So first, we're paid back all of our capital, and then it's split. But it just depends on the velocity of our money and how quickly we can turn our money. And some land investors that we work with, they're able to turn our money within a month or less. And so that's pretty powerful when you do that on an annualized basis. And I realize I didn't answer completely your question, Seth, about the taxes. Depending on the arrangement, but most of the time we'll cover the taxes as well. So we cover any expenses that come up.
And is that like written into your partnership agreement or something? Or when you say depending on the arrangement, like how would that change?
We don't use a partnership agreement. We use something called a tenants in common agreement. I mean, that's just what my attorney had told me to use and what the CPA had said was a good idea to use. So because generally we're both the land investor and myself are on the deed. So
yeah, it's going to be my next question.
Yeah, so that's generally how it works. Now, there's certain situations where we've run across land investors that, for whatever reason, they've got something in their background where maybe they've, like one person that we know owes some back child support. And so he's going through some challenges with that. And so I didn't want any of that profit to be potentially garnished. So at the advice of our attorney, we just put our name on it, and then we just have this agreement outside. But generally, most of the time, whoever the land investor is that we're funding, they're on the deed as well as us.
That's pretty interesting. So for me, like as an operator, I feel like that would create a bottleneck if you have to sign off on closing docs. But I guess if you're both on title, like you can, if it's clear that the operator can sign on behalf of your agreement, then maybe that's the workaround there.
Yeah, it's a limited power of attorney as well. So
okay.
It's very simple. I've not run into any issues. Sometimes they'll sign on behalf of me. Other times we just sign and unfortunately, fortunately or unfortunately, I'm kind of glued to my computer. So if you send me a contract, I'll usually get it done in an hour or less. My goal is really, and what I think every land funder's goal should be, is not to complicate your processes. They should just slide right in them. So it should be very easy for you.
Well, that tenants in common situation, again, not an attorney, maybe I'm getting this wrong, but doesn't that mean that like Reid owns 55% of the property, the other person owns 45%? Like you could sell your percentage and be out while the other person's still on title? Am I getting that right, or am I totally wrong on how that works?
I haven't run into that, but it wouldn't I don't know of a time where I would turn around and resell it. But in my case, generally it would be 45% to me and then 55% to the land investor, because they're doing the bulk of the work. I'm just funding the deal.
If what Seth is saying is true, it's a risk to you as the financing person, because then the land investor could sell their interest and then you're still tied to this deal, but they're out and they've made their money. And obviously it would be foolish for them to do it because they're ruining the relationship, right? But there's still a liability there potentially.
Yeah, I'll have to talk to my attorney about that. That hasn't come up yet, but we always find out different things just because I've had 2 attorneys already review it that are actually land investors that I funded. So, but they didn't mention that conveniently. So
they probably know more than me, but I don't know.
I think it's a good idea. I'll take note of it.
Yeah. Well, I know there's because there's like joint tenants with full rights of survivorship, and then there's the tenancy in common, and there's a couple other ones I can't remember what they're called, but that's like one of the key differences between them is that one of them, like everybody owns 100% of everything. The other one is like, oh no, this person owns this percentage or share of it, and the other person owns the other share, and they don't have to both sign off at the same time. Like they could split up. And again, I don't remember which is which, but that question just came to mind.
Yeah, I think my contract has language that we both have to sign off on it. But in the event that someone stops communicating after a period of time, then the other person can go ahead and sell it. And then at that point, so let's say I was doing a deal with you, Seth, and I was funding a deal with you. If you didn't communicate after a certain period of time, and I've tried multiple different avenues to communicate with you in written format, certified letter, so forth, I think that's all written in that tenants agreement, then I can proceed forward with selling it on my own. And then what I would do is I would just have the title company cut you a check on the sale. So that's I think how it, but I don't think that the way that the contract is worded right now is that one of us could just sell our share to, let's say you sell your share to Jared. But that's a good point.
Well, hey, I wanted to circle back a little bit to something that you said in passing about being somebody who can be a sounding board and somebody who is well versed in the land business and can, especially for a new person or newer person, they can come to you and kind of have your glance over their shoulder to make sure that they're not getting into a deal that they shouldn't be getting into. For me, I feel like if you offer that service, you're stepping into almost like coaching territory at that point, and it would justify a higher profit split, right? So the way that things have worked in my setup in the past, things are a little bit different now. Things are kind of being switched up, but I kind of provided a sliding scale with private money lenders. So I actually bring in people as a mortgage. And guys, me and Reid have actually done a deal together. He was one of as I was figuring things out, we were, I think we actually first met at a land mastermind group. And then from there, we ended up doing a deal together. But the way that it typically works is like if it sells within 3 months or less, it's interest paid out equivalent to 25% of the profit to the financing person, and then it bumps up between if we sell the property within 3 to 6 months, it bumps up to 35%, and then if we sell the property within 6 months to 12 months, it's a 50-50 split, and then at the 12-month mark, I actually allow the financing person to call the note due as the lender, and with I call it penalty interest, but it's not really penalty interest. It's just 10 to 12% interest, so that they at least make something for tying up their capital for a year. Now, they could choose to stay in the deal if they want to at the 12-month mark, but I give them that option because if we are sitting on a property longer than 12 months, generally I feel like that's my fault because I led us astray and we bought a bad property. Now there are circumstances that might, there's outliers. Like if we bought a property that needed some kind of major improvement or something like that, where we could, get a huge upswing if we got easement access or, rezoned or something like that. But generally speaking, I am guaranteeing that they can get their money back within a year, with, or with at least some kind of interest in return if we don't sell. So that's kind of, my run of the mill process. And the reason why I set it up that way is coming from the coming from the housing world of being a wholesaler and dealing with, kind of more conventional real estate investing. 50-50 splits are, 45-55 profit splits is unheard of outside of land. And it's very, 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 very expensive money. But it's perceived that land is more risky especially from a comp standpoint. It's harder to analyze vacant land property. And I think that's true in certain markets, like probably parts of Michigan, parts of Indiana, parts of like North Dakota, or especially like non-disclosure states. It can be pretty tricky without MLS access to wrap your head around valuation. I don't think that's the case in places like Florida or California where there's tons and tons of data available. But all that being said, I feel like the reason why I set up my program that way is I wanted to have a little bit cheaper money while still incentivizing people who were aware of kind of the run of the mill 50-50 split, to keep them incentivized to work with me. Now, all that being said, if you were bringing coaching to the table, or let's say I've only done 5 deals and I'm still pretty new. If you were to, even if it was just like, hey, I got this lead, this is where my numbers are at, but I don't know, like this data point or this outlier is confusing me. I'm a little bit, gun shy on this. What are your thoughts? Having that is a huge value. And that almost brings it I could see like a reverse of your situation where you get the 55 and they get the 45 or maybe even doing like a 60-40 split in your favor, because at that point, they're not only getting money, they're getting coaching. I mean, they really are. They're getting a different value. I'm trying to think from I call the active land investor an operator. From the operator perspective, if I was green and I hadn't paid for coaching, maybe I went through like the land master class and I had a lot of resources, but I was still really gun shy, I would totally have done like a 60-40 split in the beginning for sure, because they would have been able to prevent me from making mistakes and losing money, right? Like I think that there's a lot of value there.
That's the hope.
Yeah, and I think you're gonna get that insight no matter what, because any private, money person, they have their own interest at stake, and they're not gonna just do something stupid just because you as the active investor are all gung-ho about it, unless they really don't know what they're doing, then they might. But
yeah, I would disagree with you, because I did talk to a funder recently that funded a deal, because they called me up and they said, how, have you lost any money on some deals? What's been your experience? And they didn't ask to talk to it. Like, they didn't do any of their own due diligence. They just went off of that person's due diligence spreadsheet rather than talking to some local brokers. It was kind of lazy money, in my opinion. And maybe unsophisticated money, I guess, where they just said, I hear that there's a great deal. This person really seems to know what they're doing. I always trust but verify. So.
And I would also kind of side with Reid on that, because a lot of the people that I work with are friends and family, or they're associates from different spheres of influence in real estate, and they probably don't even know what a comp is, and so they'll have, because they're trusting in me, and they're like, hey, you have this land thing going, I trust you. Here, just tell me when I need to wire money, and I'll wire money, and you do your thing. And so there's a lot of trust on. And there's a lot of responsibility that I bear. And so I'm, especially if like people are, putting up any kind of money for marketing costs or whatever, it's like, all right, I better make sure 1,000% that this is a deal. And that's why one of the benefits of using land specialized real estate agents is that I am very good at vetting agents, and I form relationships with agents, and then my agents go and handle a lot of the heavy lifting on the due diligence side. So I'm very confident, because I'm having people walk properties, take pictures of properties. I'm working on a deal in North Carolina right now, and the agent that I established a relationship with, he's like literally going to go out and stake my property for me so that we can go get like a septic review done by the county. I mean, it's like, how do you, and I'm like, I'll pay you for your time. He's like, no, let's just, start the relationship off right and all this. And it's like, I mean, it's invaluable to have agents in place, and it gives me peace of mind, gives my investors peace of mind, all that. So I don't know. It's just really interesting, because if you're able to bring that to the table, where you're overlooking people's shoulder and saying, hey, like, this is a good deal, or hey, this is a bad deal, or hey, did you check to see if it's landlocked? Hey, I see like it's in a flood zone, like, or it's in wetlands. Did you not check this? That right there, that's like one-on-one. I'm literally holding your hand and walking you through how to be successful in this business. And I think like that's a really big deal.
Yeah, I guess I wasn't thinking about how many people might be lending money who really don't know anything or care about it. They're just kind of throwing lazy money at you. So I guess, yeah, I can see what you mean. There's a notable difference between that type of, private money lender.
And to be fair too, I'm typically in the past, I've been kind of an advocate for cheaper money, and shout from the rooftops that, kind of the anti, financiers in the land space. But if I was always talking about that in the context that the land investor, the operator, was covering some of their overhead. And if they have not, yes, if they're just bringing on an investor for the acquisition and closing costs, but they are paying for direct mail, they're paying for their operation costs, they're paying for all that, they still have financial stake in the business. And so that's where it's like, man, is it really worth it, 50-50 split? But if the financing person is actually fronting the cost of like operations and marketing, and there's like no financial risk for the operator, I think that justifies totally at minimum 50-50 split, if not higher, because they have yes, they're bringing their expertise to the table, and that's valuable, but there's no financial risk to them, right?
Except their time. I mean, it's their opportunity cost on their time. So that's why I kind of, and a lot of people traditionally have gone the 50-50 split, but we kind of said, we're not really strict on those kind of terms. We just want to look at it deal by deal. It may be higher if we feel like the margins are just really thin. But I don't know. It just depends on each deal, really. But generally, the standard for us is 45-55, 45 going to me, and then 55 going to the land investor.
So, Reid, as a private money funder for land deals, how are you analyzing each deal before you decide to get involved? Like, what is your process? What are you looking at? How much oversight are you giving?
So one of the things that I think I mentioned a little bit earlier is that I always want to see their due diligence spreadsheet. So what's their methodology? I want to talk with them on, have they talked to a couple different brokers in the area? Give me the names of those brokers. First thing is, I've had a couple people reach out to me with properties that they don't even have under contract, but they're wanting me to do due diligence on it. And I learned quickly that that's just not worth my time. And generally not theirs either. So it's better for them just to get it under contract. So we'll look at their due diligence spreadsheet, and then we have our own due diligence spreadsheet that we use on our side, where we at least talk to minimum 2 brokers in the market that are familiar with the area. But generally we try to always strive for 3. And we look at the location. We have access to data tree and all Parlay 2.0, just all the different tools that every other land investor usually uses, we'll utilize. And then we'll look at the chain of title. We'll go through and make sure, does it have legal access? What's the volume of sales in the area? We'll look at even the slope. We'll even measure the property. Sometimes I just was talking to an investor right before this, and we thought that we were buying a property that was around 6.5 acres. Turns out it'll probably be around 4.5. So we were kind of doing some drawings of it just to see. And so I think with the area of the country that we're looking at funding and where this person purchases deals, they're not too sophisticated with the counties. And so sometimes the data is just crap, to be honest. So you can't just totally go off of it. We'll look at utilities, just all the normal stuff that everybody looks at, but it's like we do our own due diligence, and it usually takes us between 24 and 48 hours.
Yeah. And I know, like when somebody brings a deal to you, it sounds like one thing that needs to be done already is it has to be under contract, pretty basic thing. But like, what are some of the other common boxes that have to be checked? Like, does it need to be a certain size, a certain value? Like, what would immediately disqualify it? And what are you looking for a good deal?
Yeah, for me, it's got to have legal access. That's pretty important. If I set up until recently that we wouldn't do anything in the wetlands, but we've actually funded a few deals that were in the wetlands and came out pretty good on, because just it's normal in that area of the country. It's got to be at least 0.1 acreage. It can't be too small. If it's really irregular in size, we usually just cut that out. We also want to make sure that if the investor is just coming to us with one deal and only wants to do one deal with us for the foreseeable future, it's probably not going to be a match. We're looking for more long-term relationships with these individuals rather than just a onesie-twosie. Those are some of the things that I can kind of think off the top of my head. I don't discount it if it has an HOA, because to me, I've funded deals that worked out wonderfully with HOAs, or that have a POA or an HOA. So mainly it's more legal access. And even then we've come across properties that don't have legal access that we've funded, and we've come out pretty good too. So it's hard to say, to be honest. I'm sorry, that's kind of like a wishy-washy answer, but sometimes there's properties that actually have no legal access, but you can still make a good dime on it.
Yeah. Is there like a minimum profit margin? Like, it needs to be capable of making at least X number of dollars, or we're not interested?
Yeah. So really the bare minimum split would be probably about 5K. So if
like
we
total
can,
profit margin?
Yeah. And that's very bare
Net.
minimum.
You're talking
Net.
after net. Yeah.
Yeah, that's net. Generally we're seeing 10 and above, but it also depends on the velocity, right? So if there was a property that we funded where, within about a week and a half, it was not that much more. I think it was like a $6,000 net proceeds, but it was a week and a half. It was like transaction funding for us. So I thought, sell that all day long. And I think that's another thing that I was going to mention, is that when you're looking at finding a land funder, you should really vet them as much as the land funder is vetting you, to see, okay, what happens if we can't sell it for this price? What happens if we've agreed to this price, but it's been a week or two or a month or 3 months. Are they willing to lower the price? And what if it's just we're coming out even, or we're coming out a little bit less than what you actually paid for it? Is the greater sum of all the deals that we've done, does that matter? Or are they going to just, say we're done after one deal, one bad deal, or one so-so deal? So I think I've just learned with other partnerships that I've been involved with that people can get a little weird when it comes to money. You just want to make sure that you see how they really react and and you can only know with what they've done in the past. And if they, say, oh, well, this guy didn't really make that much money or whatever. I just kind of feel like you just have to go with the flow on some of these things. Because if Jaron and I did 3 or 4 deals, or I did a bunch of deals with you or others, and we had maybe 2 so-so deals, but maybe there were 3 deals that were great or base hits or doubles, I'd look at the collective sum. I wouldn't look at just those last 2.
So I'm curious, do you always make it mandatory to go through like a title company or a closing attorney? And do you always get title insurance, or are you willing to fund deals for a lot of the land investors that don't typically go through a title company or closing attorney?
Lately, we've been mostly going through title companies and title attorneys, just because we do want that title insurance. For the more experienced investors, we have allowed them to self-close, and we've been okay with that. But then we scrutinize the deal a lot more.
The more and more I do the land business, the more and more I never want to close the deal on my own. There's so many things that come up just randomly that everything checks out from as far as I can tell, but then the title company finds some obscure thing, or they need some, distant relative, or they need, an HOA estoppel. I don't even know. Like that's what tied us up last time. And I was like, I've never been in real estate on and off for like the last decade and never heard of an HOA estoppel, and it's just like all these, I just love having a title company that I can call up and be like, hey, what's up with this? Like the other day, I just wanted to understand more details about when you trigger, like what event triggers a quiet title action, and when it's appropriate to pursue that and when it's not. And literally like the founder or the like owner of the title company just got on the phone with me. He's like, yeah, you do a lot of business with us, and like answered my question. And to have that in your back pocket for free, I mean, obviously you have to have a relationship with them. They're probably not going to do that if you just did one deal with them, but you build a relationship with a title company, and to have those experts at your hand, it's a huge deal. So I know a lot of people like to save, if you're buying property for $500, it kind of stinks to spend $600 to $800 on closing costs, but I would just rather buy a property for $2,000 and sell it for $8,000 or whatever.
I think you just build it into the cost, to be honest. That's what we've found is to be, and I err on the side of caution when it comes to that sort of stuff. And I always really prefer to go through that. I think it's even better when your attorney is the owner of a title company.
Yeah, that's sweet, man. It's hard to beat that. So what about terms deals? I'm curious how you approach terms deals, because I know most of the finance guys that I work with, they don't want to mess with terms. I don't really want to mess with terms either, because I'm busy working at a company called REtipster. So I don't have much time to deal with, following up on defaulted borrowers and all that stuff. But you come from, doing modular homes and dealing with a lot of seller financing. So that's kind of your wheelhouse or your background. Are you comfortable funding and staying in a deal like for, I don't know, 2 to 5 years or whatever?
Not with someone that I've never done a deal with. If I have a track record with that individual, then yes. But if I don't, then it's kind of like you're jumping from getting to know you to being married. And I don't really like that. So, the first few deals, I think we're like interviewing each other, feeling each other out, seeing how we can work together. And then and of course, the ultimate goal is always to do cash. But if we get all of our money out of the deal with just the down, and then it's payments monthly, then that's fine. There's just a few more nuances around how that's handled. Usually I want them to use a note servicing company to make sure that, they don't have to deal with it. We don't have to deal with it. But if they've got already a bunch of notes and they've already got a system in place, then generally we'll just do it with them. But the goal is always to do cash. But yeah, we actually do have 2 land deals right now where we are getting paid on a quarterly basis. So I'm open to it. And we got all of our money back on the down and then some. So, and then really how that works is that the same split occurs, just because I still feel like they put the same amount of time and energy into it. Doesn't matter if I'm waiting a little bit longer to get paid back. But yeah, so I think on that one, it's a 55-45 split, and, whatever. And then the note servicing fee and all that stuff gets just charged back to the person, the borrower, but we make our money each and every month, and it just gets directly deposited into our bank account.
Yeah, I believe with a note servicing company, the payment comes in from the borrower and then, lands in the servicing company's account. And then you can tell them, hey, send this percentage of each month to this person and this percentage. So yeah, it actually doesn't seem that complicated if you have that kind of structure set up, for sure.
Yeah. Yeah. And I know of a couple of companies that do that. I also have bought non-performing real estate notes in the past and worked them out. And so I'm familiar with some of those companies. I mean, honestly, when I think about the financing of deals like land deals versus manufactured homes, so mobile homes, I used to do that when I was like 22, 23 years old in Colorado, just fresh out of college. Imagine being 22, 23 on a cold January day where it's like 20 below and you're knocking on someone's door asking for a $350 payment because they're late. So when you don't have to do that and you just, it's a contract for deed, or whatever the arrangement is, to me, that seems a lot simpler than what I had to go through when I had mobile homes and a lot of these mobile home parks and just driving up and down, asking people for money.
On that issue, so say if you're in a state where some action is required, there's got to be a court procedure or something, even if it's just sending a notification to someone. Whose job is that? Is that your job or is that the active investor's job if that comes up?
It's the active investor's job.
And if they don't do it for some reason, say if like 2 or 3 years has gone by and they're just not, either not able to do it or not willing to do it, then it falls on you, I take it?
Falls on me, and we have that in our contract on if they stop communicating. To me, it's basically they stop communicating or they stop performing upon their agreed amounts. So it's all laid out because we have a term section and we also have the cash section. And then we also at the bottom have like an NDA section too, where we can't talk about the deal with anybody else too.
So Reid, how long does it typically take for one of these deals to come full circle? Like what is the general expectation or desire? Like, do you want the deal to be bought and sold within 6 months or 12 months? And whatever that desired timeline is, what happens if it doesn't sell that quickly? Like at what point, is there a point at which you can jump in and like, now it's yours and you can take control? Or I don't know, like what happens if it doesn't pan out by the timeline that you had in mind?
Yeah, so generally we're seeing deals turn over within about 3 to 4 months. And it was actually quicker than that before, but a lot of the title companies that we're dealing with lately are just really far behind. So that is pushing everything back. Before they could close within 30 days. Now it's like 60, some are like saying 90, which is insane to me. I like to see, what were you going to say, Jared?
I should stop complaining. I'm about like as opposed to about 2-3 weeks, I'm about 4 to 5 weeks for closing, and I've been like all mad at my title company. But if you're dealing with 60 days, that's a lot.
Yeah. And unfortunately, you don't have, in some of these areas, you only have a few title companies that you can go to, and they're all behind. So it's generally, we like to see the property sell within 3 months, but our norm is about 5 to 6 months is our contract. Typically it's 6 months. I've recently changed it to 12, just because I've just been thinking I don't really want to deal with it. And with coming to the 6 month mark, generally, if someone is not showing any effort, that's where I will kind of take control. And that's only happened once. And that was 9 months later. If I see, like, let's say I was doing a deal with a land investor, and this actually came up just recently, where we were coming, I think our contract states 6 months, and then their percentage goes to, I think, 0 and or 8. I think it's 20%. Mine is 80% now. I forget what we actually agreed to. And he called me up and he said, "Hey, I'm worried about this coming up. We're about 4 weeks away." And I said, "You're hustling. You're doing everything that you can to sell it. Let's just get on the phone and strategize, and the terms will stay the same." And I just wrote a quick email that says, we're going to continue this term for another 6 months, and we're just going to extend it, because we've done deals together before and they've turned out fine. And this property is just a weird one. So why would I be such a stickler with that contract to say, we're almost at the 6 months. Now I get 80%, you get 20. I just think that would make me a jerk. So from my stance, I just said, no, let's get on the phone. Let's see what we can do. So he was trying to sell it originally on his own rather than through a broker. So we said, let's get a broker. And we came up with that strategy, and we said, there's really not any drone footage. He doesn't normally do drone footage. And I said, how about we try this? How about we try advertising it on this website and this website? And, that's where we are. And I think it's not under contract, but we've got some prospective buyers that are driving a significant distance to take a look at it. So I don't know. I think it's all about being creative. I don't think it's just sticking to that term, unless you really have to, because the person is just not pulling their weight.
On that, again, if you're jumping on a call with an operator and like strategizing with them on how to get properties sold, like that is different. That's a different level of value, I think. That's very different than what literally all of the people that I work with do is just wire in funds, and then they collect a check like 3 to 6 months later. And if to bring that to the table, I think is huge. So don't underestimate that value there, Reid, if you're bringing that to the table. Even if it's, with certain relationships, it's different or whatever, that's a big deal. And I wanted to mention for our listeners today, something that really helped me when it came to developing contracts, because I operate with a mortgage and promissory note. That's how I structure everything. And there were some pretty intimidating things in the favor of the lender, the private money lender in my contract, that I was like, whoa, that is kind of, striking. But I realized contracts exist for a worst case scenario. If people aren't holding their weight, if, God forbid, somebody dies or somebody gets hit by a car and they're not able to communicate or perform their side of the agreement, contracts are there so that we know when we're all mad at each other and full of emotions, exactly what to do logically. So we have a natural path where, if at all possible, we can keep the relationship intact. Or if we can't keep the relationship intact, at least we can be as civil as humanly possible in light of a bad situation. So with that understanding, like the lender can call the note due at 12 months if they want to, but if it's a circumstance where it doesn't make sense for them to leave, then they could just say, no, I'll just write it out, and it's totally fine. Or if they want to, do things different, or things are a bit more nuanced in the practicals of the hustle and bustle of doing deals, then that's totally fine if the relationship is good. But the contract exists for a worst case situation. So if you see things in there, just think of that, keep that in mind. If you as the operator are doing what you're supposed to do, and you have high integrity, high communication, all that stuff, you're going to be fine. And you should be willing to and happy to allow your private money people to come in and have peace about what they're doing. Like they need to be able to be comfortable with you and set them at ease. If you shouldn't have anything to hide. You shouldn't be, like trying to do anything weird or shady. Just like be generous, lead with generosity, and understand like, hey, you're going to step up to the plate and you're going to do what you need to do, and give them as much as value as you possibly can. And as long as you do that, everything's going to work out great. So
I tend to agree with you, but I also feel like the funder should be open to suggestions. So I've basically will send out the TIC agreement to anybody that we end up wanting to fund their deal. And I turn on track changes and say, if there's something that you want to suggest making a change to, if there's something that you don't understand, if you know, have it vetted by your attorney, love the feedback. And there's been a few times where someone has come back and said, this doesn't quite make sense, or this, you know, I would prefer to say this or that. And that's actually really helped me because it's allowing me to step more into their shoes to make sure that it's fair. And I don't use, just like you said, I don't use that contract as like, oh, I'm going to take you to court over this. Because I mean, who's really going to take someone over 15 grand? You know, it's a lot of money, but I can do a lot more deals in that time. And my emotional competence and just dealing with all of that other stuff, it just doesn't make sense to just sue over that. It's just more like, here's what we agree to, and let's just try to stick to what we agree to. And if we need to deviate from it and we both agree to deviate from it, that's fine. But I kind of feel like you should make sure that your funder is okay with that, and that if there's something that you really are hesitant about, you should really ask those questions or about that. Because a lot of times I've looked at other agreements and they're very slanted towards the funder. And I don't always agree that it should be. It's the money shouldn't. The money's worth something, but it's not worth having it completely be slanted towards the funder.
I 1,000% agree, and I appreciate you bringing that up, because I don't want to suggest or paint the picture that you shouldn't read through the contract, fully understand it, and if there's certain things that you need adjusted or changed, you should totally do that 1,000%. So yeah, I appreciate you bringing that up.
On this whole thing, just the dynamic between the borrower and the lender, what are some typical points of tension or challenges or issues that may come up in this kind of relationship?
I think communication, really. I think that we've only had one land investor that we decided to part ways with. And it was more so because they weren't moving forward. Like when they posted pictures, they were blurry. It took them about 2.5 months to put a listing up. So I think it's just follow through and quality, and also respecting my money like it's your own. Like or if you don't care about your money, maybe you care about your grandmother's money, and look at it like that. And that's what I found, I think really is important for me, is just communication, and making sure that they're really in it for the long term. Because this investor, I could tell after a period of time, it was more of a hobby for them and not so much a business, or their why wasn't aligned with mine, I guess. And that was early on when we were beginning our kind of investment journey with land. And so it was definitely, I think for me, anytime that I really learn a lesson, it's usually cost me money. So, so that's what I found is really helpful, is that really making sure that you've got that in place. And then also, as we talked about a little bit before, just plan for the unexpected. What happens if I did a deal with Jaron and heaven forbid Jaron is no longer around and I need to now deal with his wife? We may not have the same type of relationship. So how do we handle that? And maybe talking through that. I've definitely talked to my funders or my land investors about that and said, here's what would take place but they're usually in the driver's seat anyways, to be honest.
Mm-hmm. So if an active investor is listening to this, somebody who wants to do the deals, they're hungry for the action, but they don't have the money. What are the right and wrong reasons to pursue this kind of relationship? And where should they go about finding these people like you? I know there's definitely some, bigger names out there who have, done a pretty good job of just branding themselves and letting the world know, hey, there's money here, that kind of thing. But that might not necessarily be the best fit for everyone. Maybe there's, I don't know, a rich uncle or somebody else who just happens to have money. Does it just come down to networking and just, understanding the lay of the land and who's doing what? And then I don't know, is there a bad reason to do this? Is there a point at which somebody has said, hey, maybe I shouldn't be going down this direction?
I think if they don't feel comfortable risking their own money, then it's probably not a good enough deal for someone else to invest in. So I found that where some people will come to me and say, hey, I want to explore this new market. I'm a little worried about using my own money. So how about we use your money? And I'm like,
it's a nice red flag.
Can we repeat that? Did you hear yourself?
Yeah.
So yeah, that's one thing. If the spread is just not there, like if we're talking like $2,000 or something, or small, or $3,000, I would say probably try to do it on your own. Yeah, I think that gives you kind of a hint into when you wouldn't want to do a deal with someone. I don't know. I found that funders, some people don't want to do a deal with me when they find out that I may require a background check. They don't like, I talked to one individual, but we can always find compromises. Like this individual said, I don't feel comfortable with that. And I said, even if I share the report with you, and even if you do a background check on me, and like, no, I don't think so. And I was like, okay, well, what if we just put the property in my name and I have a little bit more control? And he was like, okay, that's fine. So I'm in complete control of the deal. And it's good enough merit for me to say, okay, well, the spread's big enough that if he decides to just fall off the face of the earth, I can move forward and sell it on my own and then cut him the check or whatever with our agreed percentage. But I think it's all about thinking outside the box. But when it comes to that, I think if they're not willing to risk their own money, I don't want them to take a chance on mine.
I think that's actually a really good segue, Reid, for us to talk through a little bit on the deal that we did together. Because I remember one of the things that I struggled wrapping my head around was, I think at that time, again, this is very different than your current structure. You were still figuring things out. I was still figuring things out. But I remember in passing, at some point in the conversation, your preferred route to go was to take title to the property and then have me essentially get paid as a 1099 out of the deal. And from the financial partner's perspective, or the funder's perspective, that makes a ton of sense, because if anything happens to me, I stop communicating, I die, I do something shady, I violate the agreement, you are in a position where you have full control of the property, 1,000%. So you can, it's kind of like the reason why a lot of people suggest not recording the land contract if you sell a property on terms, because the title is remaining in the name of the investor, right? So if somebody defaults, you can just automatically assume control of the property without having to go through foreclosure or do any of that stuff, right? So it makes sense. However, coming from somebody who is licensed, I'm not really using my real estate license anymore, but I did go through the process to actually become like a real estate broker. Like I have a broker's license in Indiana. Which for those who might not know, there's kind of a 2-tier system in the real estate world where you're either it can get convoluted, but just to keep things simple, you're somebody who is just an agent who has to hang their license with the broker. And the broker kind of serves as like a guiding light in the world of real estate. And in exchange for that, you have to pay them a portion of your commission. I went through the process, which is you have to have several years of active experience as an agent and all this stuff. I went through the process to become like a broker. So people could actually hang their real estate license with me in Indiana. And with everything that I have been exposed to from that side, I'm pretty sure you can make a case that the operator in that circumstance is acting as a real estate agent without a license. I mean, I think you mentioned that you talked to your attorney and your attorney said, no, that's not the case. So I'd love to kind of pick our brain, or kind of just pick your brain there and walk down that path a little bit in our conversation. Because from my perspective, if you are paying somebody out as a 1099 for them to sell your property on your behalf, that's pretty much practicing real estate without a license. I think you'd be pretty hard pressed to prove that otherwise.
Yeah, that was probably one of the main reasons why I switched to doing it, where it was because in each state it could be looked at differently according to my attorney. And so, but generally I thought, could I really stand up in front of a judge and argue that? And it was tough. So that's why I just said, no, I'll just go ahead and just do the TIC agreement and make it so that way we're generally both on title. And it just keeps things simple. Plus, it's just easier. Now, there's other ways that you can structure it too. I'm exploring some other techniques with my attorney actually right now to give me a little bit more control, because technically the TIC agreement, it depends on each state. Like, I can't cover every single state, so it's kind of a blanket template. So my attorney just told me it'll generally work, but each state is different. So unless you want me to go through every single state, and I was like, I don't really want that. So it's more of like the law of averages. Like, I'm just hoping that so far, knock on wood, I haven't had too many issues. I've never had an issue with the TIC agreement. And generally, I can just work with the investor where if we want to part ways, we can part ways civilly. And I think that's just because of the individuals that I've chosen to work with. But I know there's going to be a day where I'm going to have to look at that TIC agreement. And if I can't enforce it, then I'll just probably look at it and say, how can we just part ways and somehow be okay in the end? And, maybe I'll get screwed one day, but honestly, hopefully all the great deals of the so-so or good deals that I do should outweigh just one bad deal.
Yeah, I like that. I think that's healthy. And I could understand from the funder's perspective if it was a one-off situation where a guy that you wanted to do a deal with, but he wasn't comfortable doing a background check or whatever. Like I think the tenants in common kind of is a workaround because you do have equity in you have ownership and you have interest in the property. So if your agreement is solid, you should be protected there. But I could understand why, from a funder perspective, you would shoot for that in that situation, because ultimately you're not going to be liable. It's the operator who's liable. He's the one that's practicing real estate without a license, not you.
Yeah.
So you're going to be fine.
But that has come up with another land investor that we worked with, where he talked with his attorney, and their professional opinion felt like if we did not do a TIC agreement, then, and we did another type of agreement, or if I 1099 to him, he would be acting as an agent. So we came up with this solution and we were good to go. And it's easier to do. And honestly, I just feel like, the paper, that any agreement that you sign is only as good as if you're willing to enforce it. And it just costs a lot of money to enforce stuff. And so these deals that we're doing, the highest deal that we funded was about $104,000. So as of right now. And so if it's that kind of a deal, maybe we would try to enforce it. But if it's like a $10,000 to $20,000 deal, it's kind of like you deal with your scrapes and bruises and you move on.
Yeah. We at Simple Wholesaling, I was head of disposition and I was responsible for selling 25 to 30 properties a month. And it was every single month we had properties that we lost money on. Like I think the average, I think it was like 2 or 3 properties a month. There would be ones where we either broke even or lost money, but the other ones made it up and, made it worth doing. So I did want to make a note about some of the things that you said previously. That I think that from an operator standpoint, at the end of the day, I take extreme ownership of my business and my relationships. And if I buy a deal, or if I lead us to getting into a deal that ultimately turns out bad or mediocre at best, I don't put the blame on the funder or the circumstances. I take responsibility for that because my competency, my reputation is at stake. And I ultimately want the private money person, the funder, to have a good taste in their mouth, even in the midst of things going south. So when things do go south, it is actually kind of an opportunity for you to shine as the operator, because if you step up to the plate and you lead with generosity and you go above and beyond to right the wrongs, I would be very quick under the right circumstances to lose money and have all of the proceeds or all of the revenue go to the funder to keep them happy and keep them incentivized to keep doing more and more deals. And I know that there's extremes there, right? Like there is a point where you're getting abused and you need to like have boundaries and all of that. But as a general rule of thumb, if I'm going to err, I'm going to err on the side of taking responsibility and being generous and making sure that my lenders are happy, because they're giving me the opportunity to scale. They're bringing a huge value to my land business, and so I just encourage people out there. If things go south, don't play the blame game or be primitive and all that. Like, rise above the circumstances to say, hey, what do I need to do to make this right? Even if in the short term you are taking a loss, or you're getting the shorter end of the stick. If you look at it from a long game perspective, if your funder is high quality and high integrity, that relationship and salvaging that relationship is going to pay far more dividends in the long run. So just keep that in mind.
But I think the other thing too that I've noticed lately is I've had some land investors come to us and they're kind of shopping the deal. So they'll basically come to me, say, hey, I've got this deal. And then meanwhile, they're talking to like 2 other land funders, which is fine. But I put a lot of time and energy into doing the due diligence. And it's not that I don't want them to shop, but I want, before I say like, no, I would like to at least have the ability to do my due diligence and know that if I do that due diligence, they're agreeing to do the deal with me. Because I can't tell you, it's happened to me like 2 or 3 times, and it really rubs me the wrong way, just because, and I know they're not trying to, I mean, they've got to get the best deal for them, but I kind of feel like if I'm putting in a good number of hours to research the deal out of my time, I feel like that's something that could potentially rub a land funder the wrong way. I don't know if that makes sense.
That's actually a very common thing in the commercial banking world. We saw that all the time. And it's crazy. There's not really anything the banker can do, to my knowledge, other than just waste their time and hope that they get the deal. And it's unfortunate, but unfortunately, that's not entirely uncommon. It's one of those just costs of doing business, I think.
Yeah, I think so. And what we've just told them is that if, will you give us at least 24 hours to review this? And if you need an answer sooner than that, let us know. But we have other properties in the pipeline that we're reviewing, so we want to be respectful to those other individuals. But if it's an absolute emergency, we'll carve out more time out of our personal time to look at it. And then if you're shopping it with some other people, just let us know. And then, if you like our terms, great, we'll look at it. But we would just want some sort of a verbal commitment. Now, I know that wouldn't hold up in court, but just your word that if we move forward and doing that sort of research, that you'll actually dig into it with us and make your best efforts with it.
Yeah, totally. Well, Reid, I know we're coming up on our time limit here. So if people want to find out more about you or learn more about the operation you got going, how can they do that?
The best way is to give me a call on my cell, shoot me a text, shoot me a phone call. Generally available. My number is 303-960-8542. That's 303-960-8542. Or if you want to put in the show notes, you can just have it a link to this form that most people use. Now, if you don't want to use the form, that's just it's helpful. But if you have due diligence information that you want to go ahead and send us after you have a property under contract, then just go ahead and shoot an email to me. And then Seth, if you wouldn't mind putting my email out there, that'd be great.
Yeah, the show notes for this episode is REtipster.com/107, because this is episode 107. So you can go check out that page. We'll have a link to the form that Reid is talking about, his email address. You obviously just heard his phone number, and you can get a hold of him that way. So, Reid, thanks again for talking with us. It's been very enlightening and informative. Appreciate it. And I wish you all the best in your ongoing funding activities.
Thank you so much. This was a pleasure talking with both of you. I really enjoyed it.
Likewise.
Yeah.